Hi, this is Gary DeWaal's for Bridging the Week, October 28th, November 1st, and today is November 4th. Good morning. Although many of the exchange-traded derivatives industry will be congregating in Chicago this week for the annual FIA Futures and Options Expo, the spotlight will remain focused on the CFTC's headquarters in Washington, D.C., where the Commission is expected on Tuesday to issue revised proposed new rules related to position limits for futures and swaps. These new rules are being issued, you will recall, after a U.S. federal court vacated the Commission's 2011 position limit rules during September 2012. Last week, there was no time for trick-or-treating by CFTC staff, even though it was Halloween, as the Commission fully resumed its frenetic back-to-work schedule following its October 1st to 16th hiatus by issuing sweeping new rules aimed at enhancing protections for futures customers and their funds, as well as augmenting reports filed with the CFTC related to large traders of both swaps and futures. In addition, in lockstep with the UK Financial Conduct Authority, the CFTC filed yet another LIBOR manipulation case, this time against Rabobank. Again, we have a lot to cover this week, with most of the articles, by the way, coming from the US, so let's get going. As I just mentioned, last week the CFTC approved sweeping new rules in an effort to enhance the protection of customer funds held by futures brokers and derivative clearing organizations. The most controversial provision reverses a decades-long interpretation of applicable law. It now requires future commission merchants, within 1 year after the new rule's effective date, to maintain by 6 p.m. Eastern Time on each business day an amount of their own funds in their customer accounts at least equal to their customers' aggregate under margin amounts for the prior trade date. This is the case even if all margin is expected by an FCM to be paid by each customer fully and timely. Moreover, unless the CFTC adopts different rules, the time required for FCMs to maintain this potentially large amount of their own funds in their customer accounts automatically will accelerate after December 31st, 2018 to the morning of the business day following trade date instead of 6 p.m. In addition, the CFTC adopted rules requiring enhanced risk management programs by FCMs and mandating certain new general and specific disclosures to FCM's existing and prospective clients regarding the overall risk of participating in the futures and swap markets, as well as the risk of dealing with a specific FCM. The new rules also raise the standards for self-regulatory organization examinations of FCMs. I wrote a detailed article on these new rules on October 30th, which are on my website. Check it out. Last week, when the CFTC adopted its new rules related to the protection of futures customers, it also adopted rules that 1. Add requirements related to the reporting of large positions and trading activity by futures and swap market participants, and 2. Require swap dealers and major swap participants to notify their counterparties that when they post margin in connection with uncleared swaps, the counterparties may request that their margin be segregated at an independent custodian. The new rules related to the reporting of large positions and trading activity through ownership and control reports are designed by the Commission to enhance its visibility regarding market participants, including to identify more easily relationships between trading accounts, reportable positions, and market activity. A new form expressly aimed at high-frequency traders requires the reporting of trading accounts that exceed a specific level of volume on designated contract markets or swap execution facilities, regardless of an account's end-of-day position. All required reports will have to be made electronically through CFTC-approved means. Fax, emailed, or mail reports no longer will be accepted. I was trying to find out whether Pony Express is still available, but I'm not so sure. Separately, the CFTC adopted rules that require if a counterparty to an uncleared swap with a swap dealer or major swap participant elects for its initial margin to be segregated, the account holding the margin must be maintained at an independent custodian subject to a written custody agreement. Swap dealers and major swap participants must notify their counterparties in the first instance that they have the right for their posted initial margin to be segregated. Last week, both the US CFTC and the UK Financial Conduct Authority fined Rabobank for manipulative conduct related to LIBOR and other benchmark interest rates. The FCA also cited Rabobank for inadequate risk management systems that failed to prevent the bank's violations and for the failure of the bank's internal audit department to follow up on a red flag related to the violations. The CFTC increased its total of penalties imposed on all firms for manipulative conduct related to LIBOR and other benchmark interest rates to a staggering $1.765 billion by obligating Rabobank to pay $475 million to settle this action. Separately, the FCA assessed a fine of 105 million Great Britain pounds against Rabobank for the same matter, increasing FCA's aggregate total of penalties assessed against firms for LIBOR-related manipulative conduct to 426 million Great Britain pounds. On November 1st, the Chicago Mercantile Exchange submitted to the US CFTC for its approval proposed amendments to its rule related to the conduct of exchange of futures for related positions transactions and a corresponding market regulation advisory. Principally, the CME proposes to ban all transitory EFRPs except for those related to the inventory financing of storable non-financial commodities and to foreign currency futures. The CME also proposes to amend its record-keeping and compliance obligations related to EFRPs. Previously, on September 12th, the CME also proposed to amend its EFRP rule by banning all transitory EFRPs, including those related to FX futures, except for certain inventory financing transactions. The CME's current submission parallels its prior submission, except for now proposing to continue permitting transitory EFRPs related to foreign currency futures. I discussed the CME proposal on a prior edition of Bridging the Week for September 9th to 13th. Check it out on my website. And briefly, ICE Futures US and ICE Futures Europe are delaying the rollout of their new self-trade prevention functionality designed to assist participants to avoid violating the exchange's wash trade prohibitions. Originally, implementation of this functionality was to be mandatory by November 1st for all proprietary traders with direct market access to ICE's electronic trading engine and who use algorithmic trading applications. The access to this system was encouraged for others. The new deadline now is December 9th. By the way, you remember AlphaMetrix? On October 21st, the National Futures Association said the pool operator had to pay back the funds by November 1st or all sorts of restrictions would apply. What happened? Well, AlphaMetrix has decided to liquidate all its sponsored funds and remit 90% of the proceeds by November 21st, with the remainder being returned to customers after an audit. I have a hunch we haven't heard the end of this story. But speaking of endings, the CFTC on October 29th dropped its appeal of the U.S. federal court's decision to vacate its position limit rule. Oh boy, how much money did it spend on proceedings so far? I know Commissioner O'Malley is not too happy this has gone on for so long. In any case, that's it for now. Hopefully I'll see some of you in Chicago at the Expo, where I'll be this week. But if not, until next week, this is Gary DeWaal, and this has been Bridging the Week. Have a great week.